Welcome, everyone. Those who hold the Chartered Financial Analyst designation toil every day in the global capital markets. We do so for two reasons, with two objectives. First, to protect your capital, and second, to grow it. And you all, thank you. You all give us a tremendous privilege and an incredible responsibility when you entrust us with your life savings. And we are deeply grateful for the responsibility that you and the trust that you place in us. One of the things that's very gratifying to us is that we've had people today drive down from Prescott. One of our colleagues in the industry and his wife drove down from Prescott to be here. We have clients here tonight, not only who came from around the valley, but who came from California to be here. We also have clients who came from New Mexico to be here tonight. And if you can believe it, we have a husband and wife who have been great clients of ours for many years who flew in from Tampa, Florida to be with us here tonight. You know, it's a real joy. For those of you that don't know the firm very well, we truly have a national footprint. We have clients in Hawaii, we have clients in Connecticut, we have clients in Florida, obviously, all over the country. And it's a really tremendous privilege that you give us. But it's also a big responsibility. Despite being a big responsibility, we do have a lot of fun. And we thought tonight it would be great that you would really be excited if we could lift the veil, if we could look behind the curtain and let you experience the sheer joy of what it's like to be a portfolio manager at our firm. The thing is, us CFAs, we actually like this stuff. We think it's fun. And because we think this sort of thing is fun, no one invites us to parties. This is why we exist. As a firm, this is why we exist. If we're good, careful stewards of your money, we know we give you freedom to live an inspired life. We were meeting last Friday with two wonderful clients in our office, and they're about to embark on an 89-day cruise. Okay, now they're retired, so they have time to do this, right? And during the course of the portfolio review, of course, last year was a great year in the markets, and the husband of the client said to us, "Freedom to live an inspired life," which was very gratifying to us. And his wife got a very serious look on her face. She leaned into the table and she said, "Because Capital Insight Partners takes care of our money, we get to do our job. And now that we're retired, our job is to have fun." So this is why we exist, and we thank you for the privilege you give us to do this. You know, it takes a team to do what we do for all of you. But one of the people that's critical on the team does not have a speaking part tonight. And I wanted to recognize Fallon Green, our operations associate, because Fallon, thank you, Fallon. Thank you, Fallon. I wanted to recognize Fallon. See, they love you so much, they didn't even wait for me to finish. Fallon takes care of all the details of moving money back and forth between Schwab and your banks, or attending to all the paperwork, keeping us all organized. She's a real joy to work with. As we see every time you walk into our offices, you light up when you see Fallon, more so than you do when you come to see me. So I don't know what that means. But we're very delighted that Fallon's been part of our team for a couple of years. She also had a major role in preparing tonight's event. So thank you. Well done. All right, so we go from the joy of Fallon, who I've never seen not smiling in the last 2 years, to the Securities and Exchange Commission. So the SEC is our regulator, and of course they would like us to remind you about a few things. We're going to try and predict the future tonight, and predicting the future is always a tricky thing to do, right? So that's one thing. The second is when we talk about investing, of course, you can lose money when you invest. Susan has got her brokerage licenses still, and she's affiliated with a company called MS Howells. We want to be clear that our firm and MS Howells are separate and distinct. So those are a couple of the things. I'm sure you've read all the fine print behind me while I've been talking, but just keep those things in mind. We are trying to predict the future, and we may get some of it wrong. In fact, I can almost guarantee we will get some of it wrong. Hopefully, we'll get more right than wrong. Okay. One of the things we wanted to do tonight is that when we have this event every year, we normally just focus in that bottom right quadrant, the investment quadrant. And it occurred to us that we do so many things, or we can do so many things for your families, that we ought to take a little time tonight to share some of the rest of the story. So we're going to talk tonight about 3 of these 4 quadrants, okay? A quick example that brought this topic up tonight, we have a client in Beverly Hills, and he went and decided to refinance his mortgage, and he did it on his own. And by the time we got involved in the process, it was kind of a mess. Now, we got it done, it all worked out. But it occurred to us, we maybe haven't done a good job of explaining to all of you all the capabilities that we have. So tonight, we thought we'd spend a little time on 3 of the 4 quadrants or service offerings, if you will, that are available to all of you as clients of the firm. So Donna is going to come up in a minute, and she's going to talk about that strategy piece. Then our co-founder and my partner Susan is going to come up and talk about what we call fiduciary services. I and Sarah and Craig will then finish out by talking about the investments. Now, one of the things that's going to be really fun for you tonight is we know that the way we're going to create substantial wealth for you in the years to come is to identify what's next. What's next in the economy, what's next in the markets, what great innovations, great ideas are coming next. And Sarah and Craig get to have the fun tonight of giving you a little window into our analytical work into what's next and what the future holds. Donna Woodruff is a great gift to our firm and to you, her clients that get to work with her. Donna holds the Certified Financial Planner designation, so all things related to financial planning for families, Donna does. She is also our in-house expert on the retirement plans. So the 401k, the defined benefit, cash balance plans, all the things that corporations do. So Donna joined us several years ago, and I can't tell you how delighted our team was to have her join us. You've been promoted up to senior advisor very quickly, and I think on her way to partner someday. I certainly hope so. She's a terrific professional, a joy to be with, and please welcome Donna Woodruff.
Hi, everybody. Thanks for making it here tonight. And I am going to talk about highlight some of the additional services we do here at Capital Insight Partners, in case you're not aware. Well, of course, I'm going to start with financial planning, because I'm a certified financial planner. But we can really, if you haven't visited your plan recently, or you feel like you need to kind of update some things, or maybe you've never even had a plan, please reach out to me. I'd be happy to meet with you and review what we have in our system or create one for you. The benefit of planning is just, it's your roadmap to the future. So whether you're just starting out, you're midway through your careers and your high earning years, you're thinking about transitioning to retirement in 5 or 10 years. Or even when you're in retirement, there are phases in retirement, your go-go years, your slow-go, your no-go. So plans are valid, and I think it's definitely, we can look at, things we look at in planning are going to be, long-term care insurance, life insurance if you're younger. We're going to look at Social Security claiming strategies for you. Roth conversions, do they make sense? We take a deep dive. We look at your estate plan. We like to review your tax returns just to see if there's anything that possibly could be missed. We really want to be looking out for you in every way, not just in your finances, but really, be a partner to your CPA, a partner to your attorney. We're not an expert in those other fields, but we feel like we can definitely spot things that maybe were missed, and we can direct you in a direction. Some of the fun things we've done this year, from my chair as a financial planner, I was able to help one of our clients who had a just fortunate big liquidity event. And they said, we really want to pay it forward. We really want to use some of these funds. So how can we do that? We worked with the Arizona Community Foundation, and we helped them set up a donor-advised fund where they were able to pre-fund many years of giving. And we showed them through that how, by putting this money aside now, and with us doing the investments on that account, that we could manage it to where it could sustain itself indefinitely. So that was very exciting for them. Another thing that I love to do is, if you haven't thought about this for your children, is really meet with the children of our clients. And that's, not because sometimes they're just starting out. Sometimes they're midway through their careers as well. Sometimes they're actually closer to retirement. But offering to give them a consult and a financial plan, whatever they need, whatever I can do. If I can review their benefits booklet with them, if they're just starting out in a job, help them make sure they're taking advantage of all the things that their employer is offering. You can do that as parents, but then sometimes it's nice to pass that responsibility off to someone else. And really, we know that the sooner they start, the better off they're going to be in the long run. So I'm happy to do that anytime. Any one of us would be happy to talk to your children and help do a financial plan, or just see what their goals are and help them to achieve them as well. And then, I think that basically covers that upper part of the wheel. And then I am the 401k expert in the firm. I work with business owners all the time. There are a lot of things in addition to a 401k plan that a business owner needs. We need to make sure that your insurance is okay. What is your succession plan? What are you, do you have key man insurance? There's a lot of things as a business owner. We have a lot of fortunate business owners in the past year that have been able to sell their businesses. Well, that creates a whole nother, great opportunity, but also, a little scary. You sell it and then you're like, how am I going to make these funds last? And what do I want to do now? What's my next goal? What's my next, what's my passion now? What do I want to do? So reach out to us. We really want to be your financial quarterback, so to speak. Anything having to do with finances, whether it's a mortgage or if it's insurance, anything that just give us a call. We're happy to give you our input. Steve has over 30 years of experience. I've been in the industry 20. We have a wealth of experience in our firm. So let us be there to help you. Okay, and then, sorry, I hit the wrong one. I did want to take a chance really quick, because it's in the news right now, to talk about the Secure Act. Now, there are hundreds of pages in the Secure Act, so I'm just highlighting a few that I think could impact you as an individual investor. So one of the big things that happened with the Secure Act passing is it repealed the IRA contribution limits. Now, you could always contribute to a 401k as long as you were working. An IRA, you couldn't contribute after 70 and a half. Well, as long as you're working and you have earned income, you can now contribute to an IRA indefinitely, as long as you have earned income to put in there. It has increased the required minimum distribution age to age 72. That's for those of you that have not started claiming. You have to turn you have to have turned 70 and a half January 1st or later for this to apply to you. So if you've already reached 70 and a half, I'm sorry, we can't turn back the clock. But for those of you in the future, you can kick that football down the road a little ways. Now that's part one of this equation. Part two is going to be for the IRS to revise the tables. So the tables that calculate how much you take. The reason we're extending the age is because we're all living longer. So, we were saying to Congress, why do we have to take it now? I don't really need it. This gives people the flexibility. So now if they can revise the tables, we'll have to take a little less amount if we don't need it. So they have promised, IRS has promised that they're going to do that in 2021 or 2022. So more to come on that. The elimination of the stretch IRA provision, that's probably one of the drawbacks from this, because this is for non-spouse beneficiaries of an IRA. You used to be able to stretch out the payment if you inherited it. Now it's going to be within 10 years. In most cases, there are exceptions, there are caveats, but this is something where we want to look at your estate planning documents, probably refer you to talk to your estate planning attorney. More to come on this as well, but it's definitely something that is could be a little bit of a drawback. 529 capabilities and qualifying education costs. Basically, as of 2018, you could take $5,000 out of F529 and put it towards K through 12 education. Now you can take $10,000 a year. You can also, they've expanded the definition of what schools are qualified to receive 529 funds. So apprenticeship programs, trade schools are now qualified. It doesn't just have to be a 4-year college education. And as we all know, and I was talking to Keith tonight, there's a shortage of skilled workers in this country. So to the degree that we can use these funds to put someone who had that type of skill through a program where they could be productive members of society, I think that's great. And then the last one, which is kind of a confusing one for me, you can take $10,000, up to $10,000 out of a 529 to pay a student loan. So, I mean, one would argue if you have $10,000 in a 529, why do you have a loan? I guess in some ways, if you're of the mindset of, you know what, you take out a loan, then if you do well in school, I'll pay off that loan. So, I mean, that's one way of thinking about it from a parent chair. And I have a daughter who's a sophomore at ASU, and you know, there's definitely, we expect good grades from her as well. And so that might be one way to think about it, but that's a new thing that came about from the Secure Act. The last two, penalty-free withdrawals for births and adoptions from IRAs. Each individual, so if you're a married couple, that could be $10,000 that you can take within a year of the birth or adoption of a child. And now it's penalty-free, it's not tax-free. The government's not that generous. You still have to pay taxes on that money, but you don't have the 10% penalty that you would have for taking money out under the age of 59 and a half. Okay, and the last one is the kiddie tax reverted to pre-Tax Cut and Jobs Acts. The Tax Cuts and Job Acts, as all these government acts that come through always have little things snuck in. The Tax Cut and Jobs Acts put the tax rate, kiddie tax rate at trust and estate level, which is like 37%. Now they're repealing that, and they're going to reduce it back to the parent's marginal tax bracket. So that's a benefit for people who that applies to. And like I said, there's more to come. We're digesting this. We're thinking about each of you as clients and any of these provisions that could impact you, how we can maximize them to benefit you the most as far as tax savings. So this is something we'll be talking about in our meetings this year. We just wanted to let you know that we're thinking about this. But thank you for your attention tonight, and I'll be around afterwards if you have any further questions. I can go into more detail. But I'm going to turn it over to Susan. I was fortunate enough when I became a member of Capital Insight Partners to not just acquire a coworker, but a friend. So Susan's here.
Oh, there. Okay. Thank you. Protecting the capital that is entrusted to us is our first core principle, as Steve mentioned earlier. Because of this, it's important that we pay attention to risks that will come along to take that away. One of those risks, or actually two of the risks, are elder fraud and cybersecurity. So tonight, in my segment, I will be covering these two topics. People are living longer. This shouldn't be news to any of you, but if you look at the chart on the left, you can see back in 1960, I know it's a little hard to read, but back in 1960, life expectancy was on average only age 70. And in recent years, it's nearly 80. Good news if you're in a couple. One of the two of you is expected to live till you're 80 years old in 90% of the time. So that's amazing. Nearly 50% of the time, one of you should live till you're 90 years old. So good news is we're all probably going to live a lot longer. Longer and longer, actually. And now, of course, there's the downside, which is that we start to have cognitive decline come up as more of an issue. Actually, 22% of people over the age of 71 have some sort of cognitive issues. So this really opens people up to the vulnerabilities of elder fraud. So as we have people that are older in our lives, we thought it might be helpful to just go over a couple of warning signs in case someone might be experiencing elder abuse. If someone that you know is changing their will or their power of attorneys, unexpectedly, this could be a sign of exploitation by caregivers. If someone's making unusual withdrawals or large purchases, this is another troubling sign to pay attention to. Also, if there's necessities not being taken care of by the older person or unpaid bills, this might be an issue. And finally, missing possessions. Terrible, but people do get stolen from when they're older. So ways to protect yourself now before the time comes. It's really important to make sure to review your estate documents like Donna was mentioning earlier. And it's really good to make sure that your powers of attorney are valid and what you want to have. And it's good to review it because these things change. You think that you're one and done, but a lot of times things change, and so you want to make sure that they're current. Also with trust accounts, for those of you that have trust accounts, don't assume that the powers of attorney are going to apply because they typically won't. You want to make sure you have co-trustees or successor trustees. And we're having conversations like this more and more, and it's really important to have the conversations before the time comes, because once the time is there, it's usually really difficult to make changes. One of the forms that Charles Schwab, our custodian, has added is a trusted advisor contact form. And what this does is you, on the account, can designate a person that you trust to be the person that someone in our shoes, an advisor, can reach out to if the time should come where we notice some cognitive decline, or maybe you're doing something odd, you're doing large purchases, things out of the ordinary. It allows us to be able to reach out to someone else and say, does this make sense? Are you noticing things going on with this person? TrueLink is a service that offers prepaid debit cards. So if you by chance have someone in your life that your family, older family, that you think might have possible elder abuse going on or fraud going on with a caregiver, for example, or if you think the person might be overspending carelessly, it may be an option for you to have that older person get a prepaid debit card. EverSafe is another service. They do account monitoring, so they'll monitor accounts for fraud or other examples of scams that might be on the account, that sort of thing. That's what they're watching for. So as the internet has become a bigger part of our businesses, cybersecurity grows as a big risk. In fact, the SEC is even getting involved in this. They require us to, in our business, in the financial services business, have a plan to make sure that our clients' data isn't compromised. And if by chance it is compromised, we also have another plan that we have to have in place that makes sure that we have action steps laid out before the event so that we can mitigate any losses that may occur. We also are required to do due diligence on our third-party vendors. They all must have access controls in place, privacy policies, and they're contractually obligated with us to protect your data that they house. Money movements are a bigger issue these days. The more we deal with people just over email, for example, the more the risk comes up that we might send a wire, for example, to a third party that you actually don't want to send it to. So we have stepped up our precautionary sensors to make sure that we'll call you, we'll make sure that you're the person on the other line or the other end of the email wanting the money going wherever it's going. So just know that if we are doing things like this, it's just for your protection. Dual authentication is another way to protect your assets. Again, at Charles Schwab, when you log in to view your accounts, you can add something that's called dual authentication. In addition to having a unique password, obviously we need to do that too, you can have dual authentication, which basically just puts an app on your phone that will generate a unique number that you can add on the end of your password. And this allows basically no one to enter into your account unless they have your cell phone with them. So it's an added layer of security. This year we recently updated our website. The next step in our update will include a client portal. And in the client portal, we hope to be able to upload reports from client meetings or house, your state documents and other private information. And so what we will do on that site is have dual authentication. Just thought I'd go over a couple of tips in case you're getting emails and that sort of thing that seem odd. Things to watch out for are going to be spelling and grammatical errors in emails, personal info requests. So someone like us will never be emailing you asking you for your account number. We have that information. So be leery of requests like that. Anything that you did not initiate. So for example, if there's a password reset that is indicated in an email, they may be actually just trying to get you to give them your password. So don't give out, again, back to don't give out personal information. Another thing people are doing is creating fake emails, but linking them to common names, people that you might know. So if you get an email from someone that you think you know, but the email's strange, you can hover over the display name, and if it's coming from an email you don't recognize, that's probably a good indicator that it's fraud. Also, government agencies won't typically correspond with you electronically or by a phone call. Something that they need to reach out to you by, they will mail you a hard copy letter. So just understand that if something seems suspicious, it probably is. How are people getting those of us to take action on some of these cyber things? Lottery scam is one of the things that they're doing. So what this is basically they are reaching out saying, you've won a bunch of money, now why don't you send me a little bit of money and then I'll send you the money. Well, of course, you never get that large sum. Phishing is when people are trying to gain information from you. So they'll send you an email, perhaps they'll have an attachment. You click on the attachment, it will put malware on your computer, and then they can get information from you that way. If someone calls you and says that your social security number has been hacked, and this is going to be obviously another way to get information from you, they'll probably ask you for your social security number. Again, be very leery of these sorts of things. The grandparent scam is one I've heard about a few times now. This is where someone will call an older person and they will pretend to be a grandchild and they need money urgently sent to them. Of course, they don't want you to reach out to their parent. They just need the money right away for rent or in one case it was someone traveling and they just needed money for some critical issue. Obviously, this is just a ploy to try to get money sent to them, so to the scammers, so don't fall for that one. Home repair scam is another one that affects the elderly. This is where someone will scour the obituaries for widows or widowers, new widowers or widows or widowers, and they'll go out to their home and come with an accomplice, and they will say, oh, there's a home repair that's needed. So while that person is distracting them with this home repair and the widow or widower is probably not in their right mind, the accomplice will go and steal possession. So, this isn't an exhaustive list by any means, but for sure there's a lot of different ways that we can all get ripped off. So we wanted to run these things by you, let you know that we are paying attention to these issues and we're watching them on your behalf. So now that I've sufficiently scared you all, we're going to shift gears a little bit for a happier message. The next segment Steve will be taking us through, he will also be talking about last year's great market returns. So we can shift gears to a happier message. Steve?
But here was a great year last year. It was a great year across the board. You see a lot of 30%, 20% for both domestic and foreign stocks. Even bonds had a great year, 8%. 8.72% for the bond market doesn't sound that exciting compared to the stocks, but that is a great year for bonds, 8.7%. Real estate did great in that we did 20%. No matter where you invested last year, unless you stayed in cash, as long as you actually invested your money, you had a pretty great year. And not only were the markets stronger, as an investment team, I'm glad to tell you, we also had an excellent year last year. You can't make a blanket statement to everybody that's here in the room and watching on the video across the country. But in many, many cases last year, not only did the market do great, but we actually did better. So that's the goal, and that's what we'll shoot for. And I think we should acknowledge that great portfolio manager who realized that last year might turn out okay. So let's talk about the economic outlook for this year, okay? Because the problem is, in our business, last year is yesterday's news, right? What are we going to do for you this year and beyond? So here, the economic outlook for 2020. The first thing that this slide should say is that there will not be a recession in 2020. No recession in 2020. Interest rates have been staying pretty range-bound. Part of the reason for that is that it's an election year, and the Federal Reserve doesn't want to monkey around. But in addition, they don't really need to. The economy is in kind of a Goldilocks situation where we're growing the economy, but inflation, at least so far, inflation is not a big problem yet. There is going to be volatility. Please do not be surprised if the stock market falls greater than 10% sometime between now and the end of the year. Now, we believe January 1st to December 31st, the stock market will be up, okay? But it would not be meaningful or surprising if we get one little dip along the year. There's lots of news events that could impact the markets this year. If they happen, though, I suspect they would be pretty short-lived because the economy still seems pretty strong. We have record low unemployment, low interest rates, etc. Equity valuations, unfortunately, though, do not start 2020 as cheaply as they started back in 2019, and you'll see that in a minute. Nonetheless, stocks are likely to outperform the other asset classes, and as an investment team, we believe that stocks again this year will be the top investment vehicle. Diversification is still going to be critical this year, so we don't lose our minds, though, as we're going through this election year. Part of the way we can all have peace of mind while staying invested is to know that we have some good, sound diversification in the portfolio. Okay, so where are we in the business cycle? 2018, we were having a great year, remember? Everything was terrific, and then it stopped after September 30th. In the fourth quarter of that year, the Federal Reserve decided they needed to start raising interest rates. And the market went straight down, and the president started jumping on their back. And thank goodness the Feds said our bad, and they changed their mind. In fact, in 2019, they started cutting interest rates. But what that did was it took us from up here, accelerating growth, to slower growth. And so while the economy is still growing, it is not accelerating like it was back in early 2018. So in 2019, we saw an okay economy, but the growth was slowing. And the worry was that we would fall into a recession represented by the red line. I'm happy to say what we've been doing is not going into a recession, but just kind of bouncing along here with low growth for the moment. And here's the great news tonight. Starting next quarter, the second quarter, so we are just a few months from that, we believe the American economy is going to start accelerating again. And that's partly why economists and we believe that in 2020 there will not be a recession. I'll give you some evidence for that in a bit. But first, I want to position this in light of the long cycle. I don't want to lose sight of where we are in the long cycle. And the long cycle is probably most important for most of us in this room. And the great news is that if you look at these old bull markets, they go for more or less 20 years. Well, this current bull market started in 2009. So we're only halfway through it. We're only at middle age for this long-term bull market cycle. That doesn't mean there won't be down years. That doesn't mean there won't be recessions. But we do believe we're only about halfway through a pretty good long-term cycle. Now that being said, let's come back to the current moment and talk about 2020. One problem we've got starting out here in January is that the stock market is more expensive. Obviously, starting 2019, after the bad fourth quarter of 2018, stocks were cheap. Stocks are no longer cheap. This is based on a price-to-earnings multiple. Now, stocks are a little more expensive, but they're not crazy expensive like they were in 1997, 98, or 99. And even back then, note that they stayed relatively elevated for 3 years. So just because stocks are a little more expensive right now doesn't necessarily mean that we're going to have a problem. That alone may not cause a decline in the stock market. Stocks can stay expensive for a while, but it does mean that we're going to have to work a little harder as analysts to truly identify good investments. So what we believe as an investment team, we believe that 2020 is going to bring an 80% likelihood of a positive year for the balanced economy. Now remember, we have more aggressive accounts, we have more conservative accounts. But if you're part of kind of our average investor base, this is probably going to fit pretty well what your circumstances are. And we believe it's at least an 80% chance that a balanced account like this will have another positive year. What could turn this into a downturn? Certainly a geopolitical issue. And I believe one piece of good news is that the trade war with China has been taken off the table a little bit as a near-term concern. The signing of the Phase 1 trade deal with China is certainly welcome news. We certainly all believe in the value of the fight. We certainly agree with the president on the issues that he's pursuing vis-a-vis China. The question is the tariffs themselves. Tariffs are another word for tax, and tariffs slow down the economy. And one of the things we can certainly conclude, looking at the history of tariffs, is that they kind of hurt everybody. And if you look at this recent picture here, tariffs have certainly impacted world trade and industrial production in a negative fashion. Despite that, the great news, though, is the economy in America. The economy has been strong enough to overcome the problems with tariffs and the trade war. So if the president was ever going to fight this fight utilizing tariffs as his tool, this was the right time to do it. The rest of the economy's been able to pull us through it. Certainly the impact of tariffs has been a drag on the economy. But again, just yesterday, the president and China signed Phase 1 of the trade deal. So we hope that that takes it off Wall Street's mind and out of our consideration for at least a little while. Later this year, I certainly expect we'll all hear more about trade, and that will bring more volatility at that time. But let's focus on a little more recent good news, just since Labor Day. And part of the reason for this picture is to point out why we believe next quarter, the second quarter, you'll start seeing an acceleration again in the American economy. Just since Labor Day, look at what manufacturing stocks in blue have done compared to the broader equity market represented by the S&P 500 in gray. Just since Labor Day, companies like Caterpillar, John Deere, companies like that make up the machinery, and you see what they've done since Labor Day, they've really started to outperform the broader market. To us as analysts, that's a sign that things are about to improve, and we may be seeing an acceleration coming in manufacturing after waiting for a pickup in that sector for a long time. By the way, sometimes the stock market is one of the leading economic indicators, and looking at the market and which industries are performing better or worse, that can be an indicator of where we're headed. Another piece of good news for America is that for the first time in 70 years, we are now a net exporter of oil. Now that does many wonderful things, but let's start with the bond market and also the stock market. That keeps inflation in check. Historically, one of the big problems dating back to the 1970s, and it caused huge inflation, was the price of oil. So now that America has more oil than we need and can actually export it, we've become the marginal supplier to the world, which means that not only do we have peace of mind about our own supply, but we can kind of dampen the price of a barrel of oil should it start to get out of hand. The other good piece of news on this is that it removes some of the urgency should problems surface in the Middle East. Again, we don't have to be as concerned about what's happening in the Middle East, all else equal, just because we've got our own oil. So that's kind of beneficial all the way around. And of course, by the way, for those of you who care, and we should all care about this, you know that green energy continues to grow too. We're producing more wind and solar and so on. So I told you that last year was not only a good year for the markets, but a really good year for our investment team. And again, we're just tickled to share that with you. But well, why was it a good year for us? Several things worked for us. We were diversified, and we were thoughtful in our portfolio construction. By that I mean, how did we put stocks and bonds and real estate and other alternative investments and cash? How did we do that mix? Those things all worked really well for us last year. We also had a real favorable, and this was deliberate on our part, but it worked out. Doesn't always work out. It worked out last year. We had a real deliberate focus on growth stocks over value stocks. So about, generally speaking, about 75% of your stock money with us was invested in growth stocks as opposed to value stocks. Value stocks have underperformed growth stocks for 10 years. However, in the last couple months, that may be beginning to turn. So as a team, we're working on that issue right now, and what kind of exposure do we want to have in both. But that really helped our performance last year. Our stock picking really worked too. We put so if you look at your portfolio and you see a stock that has 3% and another stock that has 1% in it, obviously we have more conviction in the 3% stock. We have more faith in that company. Well, last year, our biggest conviction names, meaning our biggest weighted names in portfolios, were great performers in the market. A lot of technology stocks, for example. And also, we kind of positioned portfolios early in the year to perform in an up year. We weren't betting on a down year last year. We were betting on an up year, positioned portfolios that way, and that worked. Now, a couple years ago at this event, we mentioned the phrase TINA. There is no alternative to stocks. We're still there. So if you look at this picture, anytime you're above this zero line, and this goes back to 1989, whenever you're above that line, the dividend yield on stocks is higher than the yield on bonds. Whenever that's happened since 1989, it has almost always been a great precursor for stocks to continue to run. For example, in this period, stocks were up 25% 12 months later after stock dividends exceeded bond yields, and the bond market actually lost 1%. Then stocks were up 30% in that example, up 5%. You get the point. TINA. If stock dividends are yielding more than, say, a 10-year bond yield, why wouldn't you buy the stock? Because you got two ways to win. You're getting a higher yield and maybe the price goes up, right? If we bought a good business. Part of why you're seeing the stock market continue to rally is, of course, the Federal Reserve is supporting it, and part of it is this issue right now. People are looking at stocks and saying they're a pretty good alternative to bonds. Of course, one of the things we worry about is all of us on Wall Street kind of feel this way right now. Another word for that is complacency. And usually when you get complacent is about when you get your head handed to you. So we're not advising people to totally sell their bonds. Now, it's an election year. We figured you're all going to have some questions about what does this mean as an investor. And so we wanted to give you an example going back to World War II, all of the elections. Please just focus down here. 12 months before all of the elections that have happened, there have been 35 of them since World War II. Usually 12 months before, the market on average has been up, and then as we get closer to the election, it gets pretty flat. But here's where it gets interesting. After the election, 5% has been the average return 3 months later, 7.5% 6 months later, 8.3% higher the stock market was 12 months later. That's across all the elections since World War II. So generally what we'd say is you might expect trouble a little based on that history. You would expect trouble in advance of the election, but once we get the uncertainty out of the way, and we all know what we're dealing with, whether we're happy with the outcome or not, we know who we're dealing with in Washington, then as business people, we can start to make decisions and we can start moving forward. And that's why removing the uncertainty of the election, in our mind, has historically been pretty good for stocks. So, what to do for 2020? Again, no recession in 2020. By and large, we believe we should stick with the strategy that worked last year because we're still in a similar environment, for the most part. Of course, we will make adjustments. Of course, we will make incremental shifts. We will, one good discipline, thoughtful discipline as portfolio managers is, let's say that we have stocks at 50% and bonds at 50%. And let's say that that was our long-term target. And stocks suddenly grow to 60%. Well, you might want to sell those stocks, turn around, buy the bonds, And guess what you're doing? You're buying low and selling what's high, which is kind of what we're supposed to do, right? And that idea of rebalancing can not only improve returns and enhance returns, it can dramatically lower risk. It's a very common sense thing. We do it for you automatically, so you don't have to worry about this. This is something that we do for you. Okay, fixed income. To be honest with you, the low yields may make it sound like the bond market's very boring. Actually, we've been very active as investors and traders in the bond market. To give you an example, at the start of 2019, in general, we had 25% of our bonds invested in what are called high yield or junk bonds. And by year end, we went from 25% to 0. Well, that's pretty active management, right? And we are now, if it looks like we're not going to dip into a recession, we're maybe going to reintroduce some of those bonds back into the portfolio. But both on the stock side and the bond side, you probably see the trades come through. We've got to be somewhat active. But in general, what we did for you last year is kind of the strategy we're starting this year with as well. Again, we're going to monitor that equity growth. Equity is another word for stock. We're going to monitor the stock growth stocks versus value stock proposition this year, because value stocks do look like, for the first time after 10 years, they might be starting to show some signs of life. Okay. Oh, so to kind of summarize this, there's a very smart strategist named Bob Dahl. And Susan and I and the team, we've followed Bob for years and years. And he works at a place called Nuveen right now. He used to be at BlackRock. But he's a very thoughtful, very smart strategist. Bob has said, unfortunately, that in 2020, he expects stocks, bonds, and cash to all return less than 5% when we get to the end of the year. We think Bob's wrong. Kind of a bold statement for us to say, because he is very prominent in the profession. We actually think it'll be better than that this year. But I did want to mention, you can make a logical case that we might end up this year with stocks, bonds, and cash at all less than 5% returns. Again, that's not our view. That's not Capital Insight Partners' view. We think it'll be better than that. But I did want to mention that. You saw earlier, our view is that it's going to be up mid to low double digits. It's kind of our 80% likelihood for this year for a balanced account. But really, who cares about 2020? It's really just 1 year. And that's not the right time horizon for anybody here to be focused on, right? And I think we should do what our relatives did. I think we should have a big party. I think we should have a decade-long party. And the reason is because it's the 20s. These are the roaring 20s. I hope they will be the roaring 20s. As you saw earlier, we do expect it to be a good decade. We do believe we're only halfway through. Yes, it'll be a year of ups and downs with the election, et cetera, trade, et cetera. But please hang in there, because keep the context that we're still just part way, maybe only halfway through what should be a good long run for growth assets. One of the great joys that happened 2 years ago is that we met Sarah LeClaire. Sarah LeClaire is a portfolio manager on our team. She has a great analytical mind. It turns out she also has a real creative flair. We've gotten a lot of feedback on our website, because we changed our website quite dramatically in the last year. And frankly, Sarah was at the forefront of that too. She is co-portfolio manager with me, or I'm with you, on a couple of strategies that we run at the firm. But Sarah has a great analytical mind. She's pursuing the Chartered Financial Analyst designation. She'll be sitting the Level 2 exam this summer, and we are so grateful to have her here. She has been struggling with a weak voice, so we hope that this works and you get through it just fine. Please welcome Sarah LeClaire. And I should have said again, she and Craig are going to talk about what's next, which is really critical.
Thank you. Like Steve mentioned, I do have a bit of a weak voice, so I apologize. I'm going to try to talk loud for the next 10 minutes or so, and then afterwards I probably won't have anything left to give, but we're going to make it through this. So, one of the themes that we have in our equity portfolio right now is business services. Now, what are business services? It primarily consists of two main segments: payments, and big data. Why do we like business services? Well, business services tend to own very valuable assets at a low fixed cost, which allows these companies to have high margins and generate attractive cash flows. So we'll begin with global payments. Global payments are payment processing systems that allow people to transact money between or exchange monetary value. Typically, this happens over many different payment types. But in a world where we are starting to see a lot of speed and transmission of both information and services, it should come at no surprise that people want to be able to send and receive money the same way, right? So what you'll actually see here are that checks and ACHs take several days to be able to transmit payment between two parties. And it should come at no surprise that those, trending over the last 20 years, have actually reduced quite significantly in the number of transactions that have occurred. But however, the more real-time type payments, like debit or credit card transactions, are increasing significantly, as we can see here on the top. So with all the increasing trend in electronic transactions, it would come at no surprise that these companies who are involved in global payment networks are going to see an increase in revenue in these areas. Well, how are companies generating revenue in this? Revenues come from account maintenance fees, transaction processing fees. You see a lot of it in finance charges on accounts. So I'm going to take a minute to orient you because I know there's a lot going on in this chart. The bars are going to represent the amount of money of revenue in trillions, that's with a T, that have been earned up until this point in 2017 that this chart goes through, and that are forecasted to occur between now and year 2022. The colors within these bars are actually going to represent different regions in the world. So the Asia Pacific region, which is down here at the bottom in the black, they account for about 60% of the world's population right now. They are projected to see the highest amount of revenue growth in global payments. But globally, we would expect to see about 9% growth per annum or per year in this area. Now, the first equity holding or stock that we have in our equity portfolio that we would like to highlight tonight is Mastercard. In Mastercard, we may generally think of them as a credit card company or a payment facilitation company, but really they have many layers of business lines beyond that, some of which are in big data and artificial intelligence, which we'll be talking about in a little bit. Mastercard is actively investing a lot of money in innovative ways to try to tie payments into technology without necessarily sacrificing the security and safety of their users. One of the ways that they do this is through a process called tokenization. And tokenization is simply taking very sensitive information, like maybe your credit card number, and exchanging it for a non-sensitive alternative. What does that mean? Well, I'll give you an example from actually another company that we own within our portfolio, Apple, which you all have probably heard of. Apple just recently came out with the Apple Card, which is backed by Mastercard. What they do is with every transaction that's made, they create a new credit card number for you. So it makes the hackers have a harder time trying to get into your account numbers. So this is just one of the ways that Mastercard's doing this. They have, as you saw in previous slides, many different business lines where we continue to see reason for them to experience a large amount of growth globally. So, like Mastercard, there are a lot of companies in the world who have just accumulated so much information and data, not only from their own consumers, but the industries that they've been working in for many, many years. What happens is with data analytics, a lot of these subscription-based are built on a build it once and sell it many times business model. And with this, these database subscriptions actually see very steady recurring revenue from its subscribers and have a very high renewal rate. So this is another busy chart, so I'll orient you a little bit. These big blue circles at the top are really just showing you how many different industries of companies are starting to use data analytics in their day-to-day business to help make better business decisions and forecasting for their future years. So the top two lines here where you see most of the dark blue bars are going to be in sales and marketing and research and development. Now, we love charts like this because they just like steadily go up, but with so many more industries and companies using this type of information, we would expect to see revenues to grow globally from that. So we are right here in the middle in 2020, where we would forecast to see about $56 billion in revenue generated. To give you an idea, because I know it's a little hard to see, that revenue is projected to nearly double in size between now and 2027, which is only 7 years away, believe it or not. So the next company I'd like to highlight that's in our equity portfolio is Moody's. Now, most of us would think of Moody's as a credit rating agency, primarily focused on corporate credit, which is like rating bonds, or real estate. But in reality, their abilities extend far beyond that. Moody's has been able to take their extensive knowledge from their credit risk analysis that they do and to turn it into need-to-know information for other consumers to be able to subscribe to make better decisions for their end users or people like us who look at credit ratings like that. So Moody has found a way to leverage what they've already built on one side of their business, repackage it, and then market it to a whole new audience of people to help them make better and faster decisions. So we like Moody's for that reason. So like Moody's and many other companies who own very large pools of data, they're not going to have people sitting behind a desk trying to make sense of all of this stuff. They have a tremendous amount of information behind them. So they're going to use technology like artificial intelligence to help them make sense of it all. Now, artificial intelligence is really most commonly used in this case for either machine learning or what's called deep learning. And what this is they take a set of information, they process it, this program takes a look at it, tries to find patterns in the information, tries to start connecting some dots. They're going to make recommendations or predictions based on what it's seen. It's going to provide some feedback of which it then learns. So it goes through this cycle here until it gets comfortable where it can say, I would like to give you an output now. So this is really a collaboration of both technology and people working together collectively for the end user, the person, to be able to make better, faster business decisions. So we have seen a big increase in investment in this area, not only from companies internally, but also from outside sources like private equity firms. An investment in the artificial intelligence software or programs behind it actually strengthens the system and increases the speed at which it can process all of that data. So what maybe used to take several hours or even several days to process, now can be completed, or the analysis can be completed within just a couple of minutes. And if you think about that and you think about what that means from a sense of productivity, I know some economists struggle to define what productivity is. I would state that is a huge innovation in productivity to go from several days of a machine or a system trying to learn something to under 10 minutes. It's really quite an incredible investment that's being made. So the last two companies I'll highlight as a part of this are Microsoft and Unilever, which we both also own in our equity portfolio. Unilever is going to be a consumer goods company who owns very well-known brands that you all probably know, like Dove or Breyers ice cream, which we all love. And they actually have successfully been able to integrate some technology that's already available in the marketplace rather than investing internally in themselves to make sense of all of their information that they have. So Microsoft produces or has developed the program that Unilever uses called Power BI. And Power BI is just one of many of the intelligence applications that Microsoft offers, but this is the one that Unilever uses. So Unilever, how they utilize it is actually they'll take all of their data, push it through the system, and it will provide them either sales, like projections, they'll do some forecasting work with it, and it will also start to recommend some cross-selling examples of their brands within that for their consumers to be able to use. So one example of this would be if you're doing some online shopping and you put something into your shopping cart, chances are you're probably going to get a little banner at the bottom that says recommended items, and most often than not, they're probably also things that would be suitable for you based on what you just put in your shopping cart. That, folks, is the power of data analytics and artificial intelligence working together to help better the lives of ourselves and the communities around us. So I think I made it through okay, which was good. I think I'll save some left for some questions at the end if you have it, but I'm actually gonna invite Craig McCrory up. He is our Chief Investment Strategist. He's also a CFA charter holder and a partner at our firm, and he's gonna walk us through some more longer term trends that we see coming next. So Craig.
This is an exciting part. So Steve clearly showed his excitement when he was up here. This is my level of excitement. I'm really excited, but clearly a different level than Steve. This is the favorite part of what we do for me in particular, is looking and decades out. I think it's really fun. I know there's a few of you in the audience that are part of future societies and whatnot. I love thinking ahead and really saying what's coming, what trends are developing. That translates directly to what Sarah was describing here just a few moments ago and parlays into what Steve was talking about as far as very near-term decisions. We hear a lot about this in the mainstream media today, is the aging of the population. So they talk about people that are 60 and older, baby boomers transitioning to retirement every single day. What they're not talking about is that group that's slightly before that middle-aged group of 25 to 59. Over the next couple of decades, that number will go to be an additional billion people worldwide. That's twice as much as the aging population 60 and over. So as the mainstream media is talking about all these concerns about aging, really behind that, there's this huge wave across the world of productivity and innovation, and from our side, consumption, that really drives some of the market opportunities that we see coming over the next couple of decades. So when you see this, what we're really looking at here is this blue chart here. Is you can see this explosive wave over the next couple of decades of that middle-aged 25 to 59 age demographic. Now, what we may have heard is that most of that is coming from Africa and Asia. And so what you're seeing here is this huge tidal wave over the next century, the blue and the red, Africa and Asia. The population today is around 7 billion people worldwide. It'll go to 10 billion people by the end of the century, and most of that growth is coming from those two continents. And so it's a massive infusion of population, and it's changing the way that we make decisions, both very small in our little world here on the investment side, but also globally, as we're seeing every day. Busy chart here, but what we're looking at is three of the same things, three charts of the world, separated by about 50 years, 45 years. The top left here is 1976. Over here is 2006, and then most recent data, 2017. And really what we're looking here is the shades of colors, and we'll focus on a couple of countries here. But basically this is GDP. So this is productivity, and we're looking at productivity of the population within each country, okay? And so if we look over here in the US in the mid-70s, we've got the shade of blue. This shows per person in the US, our productivity, meaning our goods and services produced per person, was around $10,000 to $20,000 on average per person. If you focus on over here, if you look at Asia, primarily China, that number was between $2,000 and $5,000 per person. So a drastic difference there. That difference still plays throughout the last decision making, more productive workforces in most of the major businesses across the world. The US and other developed nations here you can see are in the dark blue. So they've pretty much doubled over the last 45 years in productivity. But what you really see is China, right? If you look at this, they go from a very light shade of green to now a shade of blue. They've gone 4 times the growth in that same time period. And if you multiply that by the number of people in their population, the productivity is just astronomical, right, as you compare that. So really what we're seeing is this productivity advancement, and this is projected to continue. Another benefit of this, we can get the clicker to work here, is it's rising the global demographic out of poverty. This is still clearly a problem, but as we think about decision making and what are we doing, we're really focused at a human level for the greater good, right? And so as you see this, not that long ago, 30 years ago, if we focus in here, 1990s, about half of the population across the world was living off of around $2 a day, between $2 and $3 a day. And obviously in different places, the value of a dollar is worth a little bit different. But you can see just in that 30-year time span, that number is cut in half. And so when we think about what's happening, we're really bringing people out of poverty. We're giving people jobs. We're actually creating wealth around the world. And that's really, as we think about it from an investment standpoint, it's a balance there, right, for us. We're looking to maximize profits, make money for our clients, preserve capital, but at the same time, we want to focus at the human level, right? Make sure that this is done in the right way. So as we look at this, what does this mean for us? Here in the US, there's a lot of talk right now about the middle class and the declining of the middle class. If we take a step back and we say, okay, well, let's look at this on a worldwide. Let's look at this globally. Right now, this year, they're expecting that the actual middle class will be, for the first time in our history, the largest demographic of the world population will now be in the middle class. So from an investment standpoint, that's very exciting. Right? That gives a lot of opportunities to us as investors. In the next decade, so by 2030, they're estimating an additional 1 billion people will enter the middle class worldwide. Now, if we think about that slide a couple ago, that's primarily from Asia and Africa. But really what we're talking about here is we're bringing the world out of poverty, and everyone's trying to come up to the same level in middle class, and that's really exciting. From an investment standpoint, let's put this into numerical terms, right? So in today's world, about 35 trillion of the world's economy is through the middle class. Within the next decade, that number will almost double. So from a purchasing power standpoint, that's massive. And so we think about this from our chair. We're looking at where our opportunity is coming from. This is really coming from an age group, that 25 to 59 age group. They're the most productive. They also have the most kind of capacity for spending now, right? Because now they're entering the middle class. They need to spend money. They're raising families. They're also innovating. So these are all things from an investment standpoint that are huge trends that support what we're looking at here. And this really goes back to this one key word of innovation. So as we've been talking about what's coming, so Steve talked about the 20s. We're all excited about the roaring 20s possibly coming back again. That's really cultural changes and innovation. We're seeing cultural changes every day, right? I mean, this is what's going on, and especially here in the US. Cultural shifts are really undergoing. And so if we can get these things kind of going and focus in the right directions, along with innovation, primarily technology, this really will drive the next wave of market performance for us. So one of those examples that we're looking at here is in medicine. We touched on this last year just very briefly as far as this is something it's an ongoing trend. We all see medicine and the advances that are being made every single year, every single day in medicine. Want to point this one out. So a couple of us have young kids, and so obviously our world has completely changed. Now everything revolves around the kids. But for kids under the age of 5, one of the largest causes of death is pneumonia. And so through awareness, through innovation, through technology, if we look at this number here, this is kind of looking at it from a more broader scale, from 1990, so again, back 30 years. In the blue, children under 5. 30 years ago, 2.5 million children passed away every year from pneumonia. Through the advances that we've had, that number now, as you just alluded to, is 800,000. That's a dramatic shift. And that's not just done by someone making a decision one day and say, hey, I'm going to go and cure pneumonia for children. No, that's through people's awareness, through innovation, through technology, all of us banding together to support a cause that we believe needs to be eliminated. And just last week, they brought this similar issue up with cancer, right? American Cancer Society says in the last year alone, it was the biggest decline in cancer deaths across the US. That's massive. And that hits a lot of us pretty close to home. So I mean, this is something that, as we think about ways in which we're doing good, this is exactly what we're looking for, right? Another example of this in healthcare is 3D printing. So I mean, there's been a lot of buzz about 3D printing for a long time. The last few years it's kind of fizzled out a little bit because the momentum of that was just, they were over-promising, essentially, is really what they were doing. And now what's happening is now we're digesting. What does this mean for the world, and what does this mean for kind of industry? On the left-hand side of the screen here, what you see here is a robot, right? It's a 3D printer. It's the first 3D human tissue printer that's been created. Ultimately, what they're doing is they're building a technology that if you have an organ that is failing, they'll go and build one for you. They'll print it with a printer, which just sounds, futuristic, and we are in the 2020s now. It's the future. So this is something that, there's a lot of development that goes on here, right? We have to build this and we have to support it. But you can envision within our lifetimes, right, these things will actually be developed. On the right-hand side here, you can see this is just an estimation of what the growth in the 3D printing industry could look like. A couple years ago, $750 million of an estimate, $3.5 billion within the next 5 years. That's a massive growth trajectory, right? But when you think about what are the uses of 3D printing, there's a lot in healthcare. I have some dentist clients. This is something that's impacting dentist office every day. They're building implants. They're building those Invisalign braces through 3D printers. And these are real tangible objects. On my phone right now, for example, I have a little kickstand made from a 3D printer. They're impacting our lives, in gradual ways, but they'll be profound ways over the next several decades. Another example of this, if you can get it to work, is in energy. So Steve touched on this briefly in his conversation, but you can see here in these large columns, these are the different revolutions that we've gone through. And right now we're in the information revolution on the far right-hand side. Technology touches our lives in so many ways today. We basically are dependent on our cell phones, a lot of us, right? You can see this explosive growth in energy demand to meet that consumption need. The blue and the green here, this is basically, the light shade here is renewable energy. This is our fossil fuels, so our coals, oils, et cetera. This is the expected growth of renewable energy. And this is something that we have, definitely aware of as we're going through and making investment decisions, is this trend is really becoming real, right? We all like it. Some of us have electric vehicles. We're looking at these ways in which we can help the environment. Global climate change is a reality that we're trying to solve here. In the next decade and a half, let's say, they're expecting renewable energies to be on par with the other three major fossil fuels. So about 25% of your production will be through renewable energies, so your winds, your solars. However, by the middle of the century, you'll see this tipping point where now a third of energy will be produced through renewable sources. That's a big change, right, when you think about where we're coming from. And then Steve kind of hit this chart a little bit earlier in a different way, but we are energy dependent, right? As a country, for the first time in several decades, we now produce our own energy. The great thing about this is in most cases, the tipping point for that transition to where renewable resources are cheaper than fossil fuels will happen sometime in the next decade and a half. So let's say the next 15 years. For most developed countries, that's when they expect it to be cheaper to produce solar and wind than it would be to have a fossil fuel. That is the tipping point when you start to see climate change really get attacked. Because in this particular example, we're now energy independent, right, as a country. So we don't have this concern about having enough energy to meet our demand and the consumption of all of us within the country. Now we can focus on the big things, right? This part we've got solved. It's efficient. Now we can focus on how do we make this better for everybody. And that's really where we believe the climate change will really take impact here is over the next couple of decades. Want to finish it up here with kind of bringing it one step back a little further here is when we look at employment. Okay, so a lot of us, as we're thinking about this, work for American-based companies. A lot of what we've talked about here in a very big picture, futurist kind of planning for the next couple of decades, what we're seeing is this transition in population growth to Africa and Asia. And what that means is new business owners, new business creation. And that's just going to drive innovation and change throughout the world. What that also means is how does that impact us here in the United States, right? So what this is telling us is by country, and you can see California and Texas are the primary winners in this, is about 6% of non-governmental employees today work for foreign companies. This number will likely go up, a couple percent every decade or so, because what we're seeing is a lot of the opportunities and the innovation is not just coming from the US anymore. It's coming from around the world collectively. And that's where we see, as we think about trends and what we're looking forward to over the next couple of decades, this idea of this global cultural shift, where it's now just innovation really drives what we're seeing and reaping the rewards in the financial markets. So we're going to stop there. I know you've kind of got a lot going on. We touched on the very near term, talked about a couple of themes, and now we're talking about something that's decades in the making here, so very long term. But we wanted to give you kind of a taste of what we're thinking about and what we look for to try to identify key investment opportunities. So with that, I'm going to transition back to Steve and then open it up for questions.
You can see why I'm so proud of this team and how blessed I am to get to work with all these great professionals. And well done, Sarah, you got through it. So we're all very excited, but I really am richly blessed. And we're also, again, very blessed by all of you, having you as our clients. It truly is a privilege and a joy and an honor to toil on your behalf every day. We look forward to another good year in the markets, we hope, and certainly a great decade. Thank you.